Joining me in studio is Callie Cox, Chief Market Strategist at Ritholtz Wealth Management. Callie, it's great to have you on the show. Good morning.
Yeah, it's great to be here, ready to talk markets.
Okay, so let's do it. We see stocks right near record highs. I know you've got a lot of fact and figures to share with us here, but we're seeing a bit of a pause these past few days based on where stocks are set to open today, too. What should we make of that?
Yeah, so it looks like we're going to get day two of losses. Of course, it's early, so there's a lot of time to go. But, we haven't seen a big pullback in a while. And it's kind of funny because in July and August, expectations were quite high, and then we were caught off sides by the implosion of the yen carry trade and some disappointing economic data. So right now, it seems like expectations were abnormally low. Stocks haven't had trouble hurdling that, or more importantly, corporate America and economic data haven't had trouble hurdling that. So yeah, we're seeing a second straight slide. I wouldn't get too worked up about it. I think expectations are still quite low, and there are a lot of reasons to be optimistic.
Let's talk about some of those reasons to be optimistic. What would you call them?
Well, first of all, the economy. The economy looks okay, but related to expectations, it looks pretty darn good. I mean, again, in July and August, we got jobs data that made everybody think that we were on the edge of a recession, and it turns out that's not true. There's still a lot of value in this market, especially outside of tech and rate-sensitive sectors like consumer staples and real estate. Those are two that come to mind. And corporate America just keeps knocking the skin off the ball, really. Earnings estimates were actually quite low going into this earnings season. Wall Street expected, about 3% earnings growth year over year. And that, frankly, was way too low. And now we're seeing an 80% beat rate for earnings so far. So earnings are the focus, Kristen. But, I think estimates have gotten way too low, and that can be good for the market.
And I think now we're looking at earnings growth here for this third quarter reporting season of about 4% or higher, right?
Yeah, it was 3% at the beginning. It seems like analysts are ratcheting up those estimates, not by too much, but they're definitely moving higher. And over the past 3 quarters, we've seen earnings beat estimates by an average of 4 percentage points. So I wouldn't be surprised to see those estimates move even higher as we go throughout the season.
Interesting. So the S&P 500, I took a look early this morning, up 38% in the past 12 months. Impressive.
Very.
And on top of that, up more than 60% since the bull market started 2 years ago. Do you think it's too late for investors to take advantage of this bull run?
No, and in fact, I think it's a risk if you're sitting out this market. Nobody ever thinks about the upside risk, what you miss if you doubt a rally and you don't actually buy in.
Right.
I mean, this bull has been riding on the wave of doubt and skepticism. Recession calls, worries about inflation. The bull has been able to overcome all of them. And it hasn't been this wide bull that we've seen in past, in historical bulls. Typically you think that stocks, kind of rise together. That hasn't been the case. And I think that's actually a good thing. I'm cup half full on that. If we see the economy stay afloat with lower interest rates, we could see small caps and rate sensitive sectors continue to participate and maybe push us another leg higher.
How should investors think about potentially reallocating their portfolios in this environment?
Well, that's the thing. And I say now is a good time to prepare for a recession. That doesn't mean I'm pessimistic. That doesn't mean doom is right around the corner. But with the 10-year above 4%, around 4.15 right now, treasuries look especially cheap. And if you believe that the economy is slowing, it's probably good to start preparing, because in recessions, typically we see a 20 to 40% sell-off in the S&P.
Right.
You want to brace yourself for that. So why not take advantage and pick up a few extra portfolio cushions right now?
Other than the 10-year yield, which of course our viewers can follow, is there any specific economic data, Callie, that is telling you that the economy is slowing?
Well, the job market. When I think about the economy, I think about the job market. 70% of U.S. GDP is consumer spending. So I think you have to go to the job market first. Of course, when people are making money, they're going to spend it. And right now, we're seeing companies really pull back on hiring. Take the September jobs report out of the equation. That's only one report. The 3 reports before that, we saw hiring around 100K, which is unusually low. And we're getting this qualitative data from companies that says that they're kind of managing costs through attrition, which is hard if you're in the market looking for a job. If companies are hiring, you're going to stay unemployed for longer. That's usually the first step to more weakness. And I'm not saying that's coming, but at least it's a yellow flag that investors should consider.
I want to talk about rate expectations, because we know, yes, during normal times, corporate earnings do drive the path forward for the stock market, but certainly rate expectations and rising and falling interest rate environments have a pretty big impact as well. And so we've already seen a 0.5 percentage point cut by the Fed earlier this year in mid-September. 2 more 0.25 percentage point rate cuts, it seems to be the consensus that we'll see before year end. Does your view match up with that?
That's the biggest question that we're thinking through right now. I think the Fed has an argument to cut gradually. I also think they have an argument to cut down to 3%. So I think the speed and degree of cuts matters a lot. I mean, right now, September jobs report was strong. The 3 jobs reports before that were not strong. The Fed is looking at the labor market because its dual mandate tells them to look at inflation and unemployment. And inflation is under control, so they're squarely focused on unemployment right now. So they're at a point where they're getting some like messy jobs data. It's probably not enough to sway them one way or the other. The October jobs report is going to be messy. I expect them to keep cutting gradually because they have room to cut. And honestly, that's a great position for stocks. I mean, it's celebratory rate cuts, just adjusting policy back to normal.
Interesting. I had a guest, an economist, on just a few days ago, and he had said that he actually thinks when it's all said and done, we won't see as many rate cuts as previously forecast because he thinks the economy is holding up quite well. How could the market react to a change in course like that?
Well, it's tricky, right? Because the job market's slowing, but it's slowing at a gradual degree. And in the past, the job market hasn't slowed at a gradual degree. We've typically seen, a mass of layoffs come really quickly, and then the Fed is on their back feet having to cut desperately, down to 0 actually in the past few cycles. So I can see his or her argument there. It's hard to say where the economy is going because we're just in such a special period. If we do see the job market fall apart, the Fed probably has an argument to cut below 3%. And then you could see the stock market fall apart a little bit. Then those portfolio cushions become all the more important.
Quickly, Callie, do you have a year-end target for the S&P? How much would we rise potentially from here?
I actually don't have a year-end target, but I'm hopeful. Yeah. I wouldn't be surprised to see a little bit of nervousness around the election. Yeah. But overall, there are still a lot of reasons to be invested.
Okay, good. Callie's going to stick with us for our viewers watching, of course. Throughout the show, we're going to check back in with Callie Cox here on set with me in studio closer to 9:30 a.m. Eastern as we await that market open. All right, we are officially off to the races with the stock market open here at the New York Stock Exchange, and to talk all about it as we are right near those record highs, I'm now rejoined by Callie Cox. She's a chief market strategist at Ritholtz Wealth Management. Callie, it's great to have you back on the show here with me, and I want to talk a bit more about some of these sectors, right? So you and I have been talking earlier in the show about earnings, how that is driving the stock market, and historically has, of course, over the life of the stock market. We're really picking up steam into peak earnings week next week and the following week when we get some of these technology results. How should our viewers be looking at some of these high-flying, richly valued tech names?
Well, first of all, going back to expectations, it's all about expectations. So tech is one of the sectors that's expected to show pretty robust earnings growth, but the bar is quite high. I think earnings estimates call for a 15 to 16% rise in profits, which is high, right? If you consider that the S&P's profits will probably grow between 3 and 10%, pretty high. So tech is almost a victim of its own success these days. Big tech is pretty richly valued. It was more of a trade when higher interest rates were more of a consideration. Now the Fed is cutting. So, if you're an investor looking out long term, I probably wouldn't freak out too much if we saw a sell-off for big tech on their earnings reports. But remember, the story is compelling. If you're optimistic about tech looking years out, then it might be a good time to buy on some earnings report weakness.
At this moment in time, as you look at the market as a whole, some of these dividend payers, we were talking about athlete stocks with dividends. Of course, you can't invest in those in the public markets at the moment, we should say. But how do some of the dividend players look to you, even the small caps, maybe some of these sectors that were not as loved during the first 2 years of the bull market?
Well, dividend stocks are interesting because you're right. They're valued because they pay out this consistent income. But the S&P's dividend yield has been below inflation for so long, and I think just now it's starting to cross over, which means dividends are attractive again. And that's one of those areas of the market where there is some value left because they've been largely ignored in most of this bull market. I would throw small caps in there too, although small caps are less of a dividend play. So dividend stocks becoming attractive right now, especially if the economy stays afloat, because a lot of those dividend stocks are the steady performers with consistent income. They have to pay a dividend somehow. Small caps definitely there, although small caps are a bigger mix of unprofitable stocks. Small caps that are small for a reason, and then other small businesses that choose to be small or operate in different niches.
The housing market is such a key focus, and tomorrow we'll get existing home sales data, new home sales, I do believe, coming actually on Thursday. Rates factor into that equation as well, of course, when it comes to a mortgage. What do investors and Americans need to weigh right now when it comes to that decision of whether or not to buy a home?
Yeah, well, housing affordability is one of the toughest conversations to have right now. Mortgage rates are still around 6 to 7%, nowhere near where they were in the 2010s, and we've seen prices just steadily increase since since really the pandemic began. So I'm a pretty optimistic person. I even think that this dynamic is quite tough. The Fed is cutting rates, but there's not a guarantee that we're going to see much lower mortgage rates in the future, especially if the Fed gradually cuts, if the economy stays afloat. That's great for your job. That's great for the stock market. That's not great for housing affordability.
Yeah. And in terms of some of these housing stocks, I'm not sure how closely you might follow the sector, but do we see similar storylines playing out in the market?
Yeah, well, home builders have done really well this year, and I think part of that is on the back of the Fed cutting rates in hopes that the housing market will reignite. If you think mortgage rates aren't going to go down that much, then maybe that story is a bit inflated. I certainly fall into that camp, but I do think real estate is quite interesting because if you think about real estate, it's a mix of things in the stock market. It's home builders, it's commercial real estate, it's residential real estate, REITs, which is a mix of all of those. So, I think real estate in general has gotten hit too hard, and there could be some left in the tank because of the lower rate play. But I think you have to be careful, right? And if you're buying into real estate, I think you have to look at a basket of stocks, not necessarily picking and choosing.
Callie, what else is on your radar here as we approach the peak earnings season?
Well, the election.
Yes.
I get a lot of questions about the election.
Which just so happens to coincide with the peak earnings season this year.
Yeah, and the Fed meeting and a pretty pivotal jobs report. So it's going to be a busy week.
Yeah.
We are getting a lot of questions about the election. We're telling our clients that in the long run, very generally, politics don't matter for your portfolio. No single person can control a $57 trillion stock market. Mm-hmm. Of course, that's hard when the conversation is so loud and emotions run so high. So we try to, tell each client to look at their own financial situation, look at their tax and estate planning, consider what some changes in tax policy could mean for their situation, and most importantly, talk to their advisor or get online and learn more about what it could mean for you, not necessarily what it could mean for the stock market.
Just very quickly, Callie, in about 20 seconds time, this jobs report that we get here soon could be impacted by weather events. Do you expect that to take a toll?
Weather events and strikes.
Yeah.
I think it's going to be a messy report, even though the market's going to pick it apart.